Good afternoon, everybody. Welcome to the TraderMerlin show for your Tuesday edition. A makeup show. We were going to have our guest on last week, but the monsoonal floods down there in Florida prevented him from getting on the show, and we're going to have a little bit of a redo today. Of course, you guys know I try to bring on Bill around every 6 weeks, it seems like, right around every time we have a Fed meeting. And our topic today will be kind of a bond markets update. It is the June 2024 bond market update with Mr. Bill Addiss. How you doing today, Bill? Where you at?
I'm doing great, Merlin, and thanks to you and your audience for the flexibility. It was a little wet in Miami last week.
Did you have to take a yacht to get home?
I thought somebody was building an ark somewhere. 20 inches in 3 days of rain.
Wow.
I really swore somebody was building an ark.
Yeah, it's funny. We have Brandon Wendell also lives down there, and he's like, I'm done. I'm over it. I'm tired of, bailing out my kitchen with water. And
Right.
so he's moving to Virginia, I think, getting out of that Florida space.
Yeah, it's kind of flat there. When those rains come across, man, they whip through.
Yep.
But it's good. I finally got out the next day. So all is good. Good to be home.
I'm down here in California where I want rain. If I had to bail out my kitchen, I might actually be happy with that rain.
Right.
Let's.
Careful what you ask for.
Yeah, right. Careful to ask for. I'm higher up though. I'm not in the floodplain.
Good. All right.
Let's revisit what happened last week. Obviously, Jerome Powell and the Fed making some statements. No surprise with regards to what they came out with, although there were some changes to some of the bond selling, etc. So maybe you can give us a quick update as to what is happening with the bond market, what the interest rate market looks like, and any highlights you may have. And I do have your slides that you sent me as well.
Absolutely. And maybe if you want to put up that yield curve, because that compares where the curve was right after the FOMC meeting last week with the last meeting, so we can catch up for the time we've been apart.
Done. There it is.
There we go. Thank you. So the meeting itself, quite frankly, was a bit of a snore. There was nothing that wasn't anticipated. We've got the Fed funds rate being unchanged at 5.25 to 5.5. The discount rate, 5.50. That's the rate that banks can borrow from the Fed. That interest on reserve balances, 5.4. I mean, it's a snapshot of where we've been for the last year.
Mm-hmm.
And the real question is still on everybody's mind is, that's great for now. What are you doing for me next? Where are we going next? And, Powell continues to play what I think is a good poker hand. Interest rates are coming his way. I've been rather cynical about the Fed potentially cutting as long as inflation remained above targets. And boy, the last 2 months of inflation numbers have humbled me.
Right.
They're coming down in line. Yeah, even the perpetual bear, I can see the Fed cutting by the end of the year. If we continue to get numbers like we've seen. Again, I sound like Powell. Everything is data determinant.
Mm-hmm.
But boy, that CPI and PPI number really rocked the market last week, being as low as it was right before the meeting. How about that for timing? CPI and a Fed meeting all on the same day. I wonder if they had the results.
Right, yeah. I wonder if they were foreshadowing there just a little bit. Now, hold on a second. I got to go back to something you just said. You said that you might see a rate cut by the end of the year. Hold on a second. You bet me you're going to see a rate increase this year. This is taking candy from a baby here.
Yep, no, I'll pay off on that bet, and that makes 4 IOU when we ever get together. We're both keeping track. Yes, you're up on me 4-0.
It's not over yet.
Numbers like this. Sorry,
it's not over yet.
Exactly. The fat lady hasn't sung yet. But we still could get stagflation. We still could get a soft landing. I mean, everything is data determinant. But boy, even a pessimist like me, you got to love those inflation numbers that came out last month and in fact, the last 2 months. So if we can continue on a streak like that, I can actually understand why the equity market might be at its 30th high for the year.
Yeah, and continuing to go higher with all these mergers and AI. Elon Musk saying we're going to have 1 billion robots in the future, which means, we could all have a whole nother discussion on where the money's going to come from to buy stuff if everyone's working with robots. But all right, so was there anything in there? I listened to every part of it. I listened to all the press conference, and I agree with you. There was nothing that stood out and I was going, wow, that was a shocking piece of information. Nothing was exciting. What about the unwinding of the balance sheet? I know that's a pretty important one, and we saw some changes there, didn't we?
Well, actually, we had seen changes last time, and they maintained those changes. So for the last year, as part of their tapering program, the Fed has been destroying about $90 billion a month. So for the last year, they just hit the $1 trillion mark of destroying cash. So what they did at this meeting was they reaffirmed that they're only going to be tapering $60 billion now going forward. They've got $35 billion they're going to be destroying from their treasury portfolio. The interest and principal that comes into that portfolio, they're just destroying the first $35 billion. And then they're going to do the same thing from their big mortgage portfolio to the tune of $25 billion. So the Fed and honestly, this makes a lot of sense. If the Fed is going to be cutting, they shouldn't be tapering at the same time. Tapering makes rates go higher.
Right.
It makes cash less available. So you don't want to be doing two things that are directly contrary with each other.
Mm-hmm.
So they reduced the tapering from 90 down to 60 at the last meeting. They kept it the same here, but realistically, they're going to have to stop tapering when and if they're ever ready to cut. Otherwise, they're just polluting in their own pool, as the term might be cleaned up as saying.
Right. And, you heard the comments from Powell talking about how there may be the need for some rate cuts near the end of the year. And, of course, he said it every time that's going to be data dependent. In my mind, I'm looking at the kind of the pattern that we've been on, and this big holding pattern. We've just kind of stuck at this level for a while. The economy seems to be doing great, and there's no need at this point to cut rates. What argument would you say that there would be for cutting rates? I don't really see them needing to do it.
No, I've been of the camp higher for longer. I've been screaming that, 0.34 is not 2%. So I was of the higher for longer, and, we even had a beer on hike. I was thinking even hike before cut. But we're going to get inflation numbers like this. I mean, they just couldn't look any prettier in terms of inflation coming down, energy costs, food even. So we could get another couple of months like this. We'd be in smooth sailing. We could actually get that magical soft landing, perhaps.
Oh, it's like a unicorn. You don't really see it, but
never seen one before. But maybe this is the year. So the Fed, though, I'm still going to play devil's advocate. We still got a boatload of cash out there. I'm fundamentally a Keynesian. You got too much cash out there, that leads to inflation.
Right.
And, I sent you that M1 chart. You and I have been talking about this M1 for a year now. It's coming down a little bit, but geez, there's an unprecedented amount of cash still in the economy. So that's my nagging, hairs on the back of my neck are just looking at all this cash saying we could still have problems.
I got that chart up here, and this is M1 money supply. This is just the cash and cash equivalents for U.S. dollars. Right. And, you see that spike that happened because of COVID. We all know that was, obviously the biggest infusion of capital in the financial markets in the history of mankind. Right. However, if we were to draw a line on this and come up with just a historical norm and say, okay, markets have been trending up and maybe this is where it's headed. Let's see if I can actually draw on this PowerPoint. Yeah, I'll continue this line and just kind of continue to move it up here. That means we should be selling off and head back down to somewhere around 6 trillion, 8 trillion if we're being really generous here to continue with that trend line that started from 2010 to 2020. Where do you think this is going to get back down to? I mean, I have a hard time believing it will come anywhere near 4 trillion or even 8 trillion just because, they're high on their own supply. They're addicted to this, flooding the markets with money and bailing everything out. I just can't see them going back.
And I tend to agree with you. You can't put the toothpaste back in the tube because this, as you know, this chart goes hand in hand with the Fed's balance sheet. Mm-hmm. And the Fed has really said, they're not aggressively looking to lighten up their balance sheet. They're doing some tapering just as a maneuver. But, they're in no rush to dump their balance sheet either. And so put the two together, I think we're going to learn to live with a lot more cash in the system. The question is, though, again, I can't help myself, does that mean a more fundamental, higher level of sustainable inflation?
Right.
Are the 2% days gone? Maybe not, if you look at the last 2 months.
Right.
But there's just so much cash out there. But the Fed is perfectly willing to hold on to all of that balance sheet. They don't seem to be in any rush. So maybe we're just going to learn to live with more cash. But I do believe that means traditionally we're going to be living with more inflation.
Right. Well, and to go back to Powell and the Fed's kind of 2% target, why is it the 2% target? Is there any logic behind choosing that number versus 4 or 5 or 10%?
Actually, I read an article about that actually came back. If you go to going out of the pandemic, the first time you see a central bank was the European Central Bank, and it was just a question off the cuff, and he said 2% seems to be a good sustainable rate. And
Just pulled it out
suddenly,
of thin air.
like everybody was focusing on 2%. There's nothing magical about 2%, So, but it supposedly gives you a level of growth without inflation. But that's really what the neutral rate is, for those eco nerds out there. And the neutral rate is closer to 4%.
Mm-hmm.
So I just think we got too much cash out there. Yeah. I really do.
I'll bring up a chart here. This is from Trading Economics. This is the United States inflation rate going back into the 1920s. And I'll put up my cursor right where 2% is. And, I mean, it's significantly low. It's historically low. I mean, obviously, we've gone negative a few times, deflationary in the 1930s, and you see a couple other ones here. But I always just question that 2% mark. Like, why? It just seems like, either way, we're really pushing, or they're pushing aggressively to get down to that 2%. And as you mentioned, not only the CPI, but the PPI and that core PCE price index numbers posting some pretty favorable readings. I think you're going to see a lot of volatility this year. When we go back to the very beginning of this year, I was saying that I think you'll see inflation, gyrate back and forth and be fairly volatile, particularly because of energy costs and housing costs, which, now all of a sudden, the past 2 weeks, we've seen a really sharp spike up in energy prices. So who knows if our next month's reading...
was deflationary last month. X energy was, the number went the other way. So energy was deflationary last month for a change. I agree with you. We're going to see a lot of volatility on inflation. I absolutely agree. We saw 4 months of upward, then 2 months of down. It's going to gyrate. But I worry about all this cash. I'm not going to lie. But if the Fed has been able to pull this off, if they can really achieve the type of inflation numbers we saw last month, more power to them. Powell's the savior if he can do it.
Yeah, I have a hard time believing it, honestly. And I think I've told you this before. John O'Donnell and I interviewed a guy when I was hosting Power Trading Radio, and he worked for the Bureau of Labor Statistics. And we asked him, I forgot which metric it was, but we said the recent number was this. And I asked, is that data manipulated? Because we all hear that it is. And the guy said, without hesitation at all, he says, yes, it's manipulated. And I just was kind of floored that you would admit that. Now, he didn't work for them anymore, so he's kind of like, yeah, whatever. But he said they typically will manipulate that to benefit a political party or an agenda or something that needs to be done. And I said, well, how are we supposed to have faith and trust in those numbers? And, when we look at this data, to what extent do you think that it's being tailored to fit our current administration hoping to get reelected?
That's a good question. And, prior to 6 years ago, I would have said at the government agency level, we didn't see manipulation. And maybe I was just being naive. Because I think when you have human intervention, and I think, it can all be glossed over with seasonal adjustments, right? Mm-hmm. Isn't that the magic phrase, seasonal adjustments? Yep. I am getting a little bit more skeptical that maybe things are distorted sometimes to an agenda. As I hate that admission. Yeah. I felt that the quality of our data was good, and we could look at other countries like China and question the numbers coming out. If we're no better than that, what does that say about us?
Exactly.
But, I am getting a little bit cynical, I guess.
Well, I think it's just you're a realist. You look at it and you know that there's a little bit of manipulation going on there. And there's a good question from Ken that came through. He says, how much does the election and the amount of interest that the government has to pay in that interest factor into cutting rates?
Well, realize what the Fed has done in terms of raising short-term rates so aggressively at a time when the government has about 40% of their debt coming due in the next year. Interest costs now are the second largest expense. We've topped over $1 trillion. But, the paradox here is by the Fed raising rates, they've made it much more expensive for the government to borrow money.
Right.
So the good news is, even when the Fed does start cutting, the government will benefit from that. The Fed also is hurting themselves. They're continuing to lose money this year because they pay those high short-term interest rates to banks and asset managers. And so they're having to pay the highest rate of interest. So the government is getting hurt by high interest rates. The Fed is getting hurt by high interest rates. Again, their mandate is not profitability. It's monetary policy. But absolutely. The government is getting hurt. And, this number astounds me, but almost 40% of the government's debt is coming due in the next year. Meaning we got to roll that debt over in addition to the new debt that our elected officials keep piling on. We got a flood of supply still coming in the marketplace.
To Ken's question there, if we do have all of this, 40% coming due in the next year, then assuming they're going to just roll it into new debt.
Right.
And,
Sure. Absolutely.
by cutting rates and maybe aggressively cutting rates here, it puts that government in a position that when they do, lock in, it's going to be at much lower rates.
Right.
So it would seem to benefit the current administration or any government to have a much lower interest rate here, especially if all those bonds coming due. And to what extent do you think that factors in? Do you think we will see cuts just because of that, or no?
No, I really don't. Again, I believe the Fed is autonomous. I really do. I don't think the Fed is acting in Biden's behalf or Trump's behalf. I mean, we know the problems that Powell and Trump had in the past, but I don't believe the Fed is a political organization. Maybe I'm just being naive. But I really don't believe. The other problem is, to work to help a president, and this is not true of just this president, any president, they don't really impact the economy at all. Mm-hmm. I mean, the president has no say on what energy prices, fuel prices are. The president has no say on anything. You've got Congress on the one hand doing fiscal policy, and you got the Fed doing monetary policy. The president's not in that picture at all.
Well, he could be vetoing policies, and he could prevent certain bills and measures from going through and pipelines and things like that.
And things that they do. Right. Sure, we've seen a very active tariff policy, but does you really think tariffs actually affect the economy that much? But I will agree, both President Biden and President Trump have been very active on the tariff policies in an effort to, penalize our enemies, I guess, and make friends with our friends. But the president really has very little sway over the economy.
Yeah, I don't know. I think I would slightly disagree there. I think that his policies and the plans he puts in place certainly do impact the grand economy. If you look at
what? Can you give me a specific
when we did our whole industrial package, right? We were talking about infrastructure package, and that all that policy and change flooding the markets with money, that does impact those segments of the economy, and you get some growth in those areas. Now, I don't think it's necessarily impacting the value of the dollar or interest rates per se, but as far as job creation through spending, I mean, we know historically that a Republican president is much less on government spending, whereas Democrats are much higher on spending, and therefore markets perform better under Democrats historically because of that spending. So I think they do impact it. I wouldn't say it's the driver, but there is an impact there.
Okay, I would agree. I would also say a lot of that is also Congress passes budgets and does all that. Not as much the president, but it's elected officials. Yeah. So it's 6 of one, half a dozen the other.
They kind of say, let's point the ship over there, and then it seems like everything kind of pushes in that direction. The Ouija board of the markets, if you will.
I like that. I'll steal that. I like that.
You feel free to pirate that one anytime. Let's see. What else?
I'll give credit.
Oh, yeah. I don't need credit. Let's see. I want to go through your chart because you had some good ones. So you already mentioned the Treasury buybacks. We got that part out of the way, right?
Well, actually, we didn't. So if I could just clarify that, because this is the second time the Treasury's ever done this. So for Treasury nerds like myself, this has been kind of interesting. So the Fed is actually concerned about the liquidity of the bond market, believe it or not, even in spite of all that supply we've got, because we've got a lot of small issuances out there. Back when the deficit wasn't so bad. Mm-hmm. And we're actually having some settlement problems on treasuries. And they should be risk-free, effortless-free. So in an effort to clean up the market, the Fed announced in May, that they're going to start doing treasury buybacks. They're going to go into the market and buy back smaller, illiquid issues, what we call the off-the-run issues. Mm-hmm. A couple of $1 billion issuance that was done a couple of years ago that doesn't have a lot of liquidity. The problem is they have to borrow more money to do it. So we're not increasing the deficit by doing this, but we're issuing new treasuries to pay off and buy back older treasuries. So the net amount of debt outstanding as a result of this maneuver is not increasing. We're just trying to create a more liquid market by getting rid of these old museum piece bonds that are still out there. So the Fed actually introduced an auction process. They do a reverse auction. And it went very well. This is only the second time in U.S. history the government's ever bought back treasuries. The first was under the Clinton administration when we had that surplus for a brief period of time. Mm-hmm. They went out and bought back high coupon treasuries during that time. It's like, why pay interest if we don't have to? So that buyback was targeting high coupon treasuries. This one is targeting smaller illiquid issues. But the truth is the government's paying a pretty good price to buy these treasuries back. Problem is, you and I as retail individuals can't take advantage of this. It's all done through the dealers, those 24 primary dealers. So they're the ones who are selling the treasuries back at a nice profit, or a better than market rate. I shouldn't say a nice profit, but a better than market rate. They're selling them back to the Fed for.
So let me see if I got this straight. So
Yeah.
the Treasury is always issuing different denominations, right? So you got different bond products coming to market, and apparently we have these off-the-run ones you mentioned that aren't very popular. Not a lot of people are buying them, so they're just kind of sitting there with no real market. So now you're saying that they're going to issue other more popular bonds, let's say the 10-year, the short-term Treasury.
Right.
Take that money, buy those ones, and remove them. Take them away.
Correct.
Wow.
Correct.
Wow. Okay.
Now, the
Seems like a
popularity,
manipulation tactic, but okay.
Well, but it is trying to clean up liquidity
Sure.
because we've actually had this repo market that you and I talk about a lot. The repo market has actually had some problems because of all these small issuances out there. So when we say buying back less popular ones, the popularity is simply based on the size of the issuance. If it's a small deal, it's relatively illiquid. That's the ones they're trying to clean up. But I would point out a lot of these are at higher coupons. So the government is actually buying back some higher coupon paper to replace it with lower coupon paper for the most part. So taxpayers should be happy about this as well.
Big Eb says, Yasin here, is that buyback to help small banks?
No, having nothing to do with the stupid bankers and the banking crisis out there. No.
Okay. Yeah, because these aren't issued by the banks themselves, but the banks may be holding that paper.
The bank could be holding them, and if the bank does happen to be holding some of these illiquid issues, the good news for them is they're going to get a good price for them.
Right. However, they're going to have to go back to the market. They're going to have to go back to the market and get some new paper at a lower rate.
Right. Exactly.
It's like it's great because we're getting to get a premium for this real quick, but then all of a sudden we're stuck with long term looking for something else to get premium on. Pretty funny.
Yeah. Yeah, but no, and that's a great question, but no, this is unrelated to the banking crisis.
All right. Jimmy says, let's see, Jimmy. Oh, this is more of a macro question. I don't know. I think, are you an Austrian economist or are you more of a Keynesian? What do you think?
I'm more Keynesian, but John McDonnell and I have had some conversations. I know he favors the Austrians.
Yeah, I don't know if favor is the right word. He is a diehard. He would spit on John Maynard Keynes' grave if he walked by it, I'm pretty sure.
And I enjoy the dialogue. I really do.
Viewpoints and opinions are always good to see kind of what people think about different topics and subject matters. But Jimmy says, why would Keynesian be better than Austrian for our economy? And I think that's you could almost do a whole show just on that. That's a huge can of worms there, Jimmy.
I would welcome. Let's get John and I on a panel and let's debate it.
Okay, I'm going to write that down.
I'm not willing to debate. I'm sorry. Go ahead. I talked over you.
No, you didn't. You and John talking economy would be great. I would love to do that one. I don't see how we can do it with 3 people. It's a little bit more challenging on this end, but if I had TJ, my chart
willing
master.
to debate is MMT, modern monetary theory. Let's take that one off the table.
Okay, none of that.
I'm not even going to discuss that one because it's unrealistic.
Okay. All right.
It assumes you can keep borrowing as much money as you need. I keep stressing. My problem is we know the government needs to borrow a lot of money. The question I worry about going down the road is how much demand is there.
Right.
And MMT just assumes you can just keep issuing as many bonds as you need to finance your deficit and you're not going to pay it back anyway. Well, there's a fallacy there. Just because you want to borrow money doesn't mean people are willing to lend or institutions are willing to lend it to you.
Right. Well, I mean, we're kind of going down that path now, aren't we?
Well, I got to say, and again, my optimism, I think my Prozac is kicking in this month. Talk about optimism. The last 10-year auction we had 2 weeks ago, we had the best bid to cover ratio we'd seen in months. We had more demand for that 10-year than we've seen in a while. There was a bid to cover ratio of 2.67. We had 2.67 more times orders as we actually had treasuries. We haven't had a number that high in years. So we got strong demand. Even though we're flooding the market with lots of treasuries, we still continue to get strong demand.
Yeah, and that 10-year, I mean, we've seen the yield for that 10-year drop over the past few months, to my surprise, to Big Ed, one of my viewers, Big Eb's joy, because we have a wager on this one. He thinks it'll be under 4% by the end of the year. And, man, if the trend is your friend right now, Big Eb, you might pick a place and buy a schooner of beer for you, because it looks like that could happen. Yeah. It could happen. We got a long time to go, but we're halfway through the year, and not too far away from 4% on that 10-year. But, that strong demand is what's ultimately pushing this yield lower. Because if they're selling more of it and people want it, they can offer lower rates. And we're seeing that reflected.
Exactly. Yep, the strong demand was a big surprise. So that change in rates that Ed was talking about, it was in that first slide, if you want to go back to the yield curve. If you look at that 10-year, at the last FOMC meeting, 8 weeks ago now, the 10-year was just over a 460. Now the 10 years at a 4.25.
Yeah.
That's a pretty substantial drop. So, it's certainly the trend is in Ed's favor. I'm still not convinced, but hard to stand up in front of a locomotive.
Yeah. And that you look at that little gap there. I'll mouse over here so you guys can see it. This is this difference between these two red dots and that 10-year line. Really going, it's not that it's that long of a period of time either. It's 45 days where we've seen it drop from over 4.6 to just over 4.2. And if that continues like that, this is going to be a catalyst for the housing markets, because the lower the 10-year goes, the cheaper the mortgages rates are going to become, et cetera. And this could be a very positive thing for the housing market. Of course, we're already in a situation where housing prices have been driven astronomically high. Rents are at historic highs. And this may further accelerate that increase in prices. So while it looks great on paper, there might be a long-term impact here, which could be much higher real estate prices. And don't forget, real estate rents are the largest component of inflationary data for CPI and PPI. Just throwing that out.
Absolutely. And as you pointed out, when people should follow, when they want to follow where mortgage rates are going, you follow it to the 10-year. Mm-hmm. That's the benchmark. So you're absolutely right. Keep an eye on that for the mortgage market.
It's so weird because you look at it and you go, okay, well, if it's a 30-year fixed rate mortgage, it should be off the 30-year bond, but in fact, it's based off the 10-year. It's a strange one.
Well, it's. I'm going to get nerdy on you for a moment. If you look at a mortgage-backed bond, you have all those principal payments are paid out every month. The bond is self-destructing, versus a normal 30-year bond would have all that principal at maturity. So a 30-year bond, when you look at the actual cash flows of the bond, monthly payment of principal and interest, it actually looks, smells, and acts more like the 10-year treasury due to its average life concept, the concept of duration.
Mm-hmm. Interesting.
So I'm sorry to get nerdy there.
No worries. Big Ab, you cracked me up. He says, I just got a Biden fundraising commercial. Did you set that up? Absolutely not. I am not pro either of these candidates. I'm standing out of it. I am a disappointed, disheartened, and concerned American that these are the two best people that we have. So I would not be supporting either one of these individuals. I'm sorry, but that's my political statement. I'm sticking to it. I want a bumper sticker. We saw one interesting the other day. I was walking and I saw a bumper sticker in a car and it said, anyone under 80 for president.
Well, that's it. This is the best we could do as a nation.
Yeah, but Trump's like 78. I want to go down to, let's go to 75. Let's get those two out of the picture and find better people to run our country that are amicable and friendly and good. But no, I did not set up a Biden fundraising commercial. Big up, you're funny.
Oh, I got to go. I got a fundraiser I got to go to. I'm sorry. I got to go.
Got to go, yeah. And our next guest, President Biden, will be on the program. Call now and send your money. No, we're not going to have it that way. What else in the bond world is tickling your fancy? Anything exciting and new? I mean, obviously. Oh, how about I-bonds? Any updates there? Any change? Any? No, they don't change for 6 months, really, but
low. Yeah, no, great question. And we just did a reset, obviously, in May, so we got a ways to go yet. But if we keep looking at CPI numbers like this, you're going to want to be cashing out of your I-bonds. You have a lockout period for a year. But after a year, you can redeem them with 3-month interest penalty. Mm-hmm. But, the nature of any floating rate instrument is it's a double-edged sword, right? We were recommending this because inflation was high and it was a great catch. And, we hit some 9% yields. But now with inflation going where we want it to go, I-bonds are going to suffer as a result. So, if I-bond yields go below 4% in today's market, you really should be looking at just regular good old coupon bonds.
Good old coupon bonds, right?
The non-floating variety.
Well, it does feel like we're in an environment now where the yields will start to either sideways for a while or slowly start to drop. I still think we're going to be going higher. And again, that goes back to the discussion we've had many times about the short end of the yield curve. If that remains fixed, that long end should naturally creep a bit higher. And, you're seeing still an inverted yield curve. So I do think that the long end will move up. That's been why I made that wager with Big Eb on this program. But hey, I could be wrong. If they cut drastically that short end, we may see that long end of the yield curve drop even faster.
Yeah, and as we know, the yield curve is dynamic. Now I'm getting a little concerned, though, Merlin, because I actually agree with you on the long end. I'm with you that higher is where I think we're going. I'm sorry to be contrarian to Ed, but I think all the supply coming in and all this money still scares me, but I'm not going to stand in the way of the inflation numbers we've enjoyed for the last 2 months.
Yeah, it's hard. I
don't think it's permanent.
Yeah, I'm with you. I think it's a short-term piece, but hey, all in all, it'll be great for the economy if we do see that inflation drop lower and lower. So fine, I'm okay with that, but I'm not a believer at this moment in time. I still feel there's a little bit of
One number does, or two numbers do not a trend make. So I'm enjoying it. I'm happy for it. Let's see.
All right.
One of the things I do want to mention, though, if I could, because
Sure.
we've been talking about those short-term bond ladders we were doing. And if you look at that yield curve, the 1 month T-bill is no longer the highest yield in the market. For the last year, we've been rolling 1 month T-bills every week
Yep.
as part of ladder strategy. Well, if the Fed is going to start cutting, and if we're looking at, even the dot plots are calling for a cut by the end of the year, it might be time to start thinking about extending your maturities, maybe going, locking in today's rates for a longer period of time. And that 3 month T-bill is actually now higher yielding than the 1 month.
Yeah.
So this might be a time for those people who've been doing the ladders to think about extending out and locking in today's rates for a longer period of time before the Fed cuts. And the market's rewarding you for it a little bit.
I mean, it's the highest yielding product right now. What does that say to you? I mean, you've been doing this for 40 plus years. Obviously, in a normal yield curve, the long end is the highest, the short end is the lowest, and it's a fairly linear graphic. Why do we have this arc? Why is the short end of the yield curve not the highest? Why is that 3 month, the highest one? And what does that signal to you?
A great question. And I actually was involved in a debate about this with somebody else who's still on a trading desk. Believe it or not, more and more people are thinking that this is the contrarian view that the Fed's going to do one more hike before they cut.
Oh, wow.
We can actually see it. Now, again, it's only by 2 basis points, so let's not blow it out of proportion. But still, the marketplace is still not convinced, kind of having the same conversation you and I are, because as we've been discussing for years now, the yield curve is a forecasting tool. It's telling you what the market is expecting. And what the marketplace is saying is 3 months from now, they're expecting those rates to be higher than they are today. The only way that can happen is thanks to the Fed. So we're actually seeing a very slight, I want to stress, this is not landmark, pricing of a potential hike.
Wow, that's interesting. I will go over here and show the viewers. You can't see this one, Bill, just because you're not watching this one live, but unfortunately you can't. I'll read to you what it is. It is the Fed Funds Futures, which I like to reference all the time, and just to kind of see what traders are actually betting on. Right now, if we go out 3 months and look at the September FOMC meeting, there is a 32% chance that we're going to stay exactly where we are at. There is a 61% chance we will have our 25 basis point cut by September. So, and just to update that for everybody, because we've been following this one, if you go to the end of the year, right now, the markets, the traders have priced in a 42.9% chance of 2 rate cuts by the end of the year, dropping 50 basis points. So a little bit conflicting there, right, with the 3 month and those the table here from the CME.
And also conflicting with the dot plots. I might go back. We haven't talked about those too much. I don't really like them, but we should explain. We've got a transparency out of the Fed right now, which is unparalleled. Not only do we get the policy statements, the notes of the meetings, a press conference, but they literally poll the 12 voting members of the Fed on various topics like, where do you think unemployment will be, inflation, so on. And they chart that out in what we call the dot plots. So we get literally what the perception is as these economists, and that's what they are, what their expectation is. And their latest dot plot has, paradigm, has only one cut, there we go, one cut between now and year end. So you're right, the futures market is pricing in 2. The Fed is pricing in or saying they're only expecting 1, and the bond market is actually starting to show a rising 3-month rate. Those are 3 different convictions about the market.
Yeah, I'm going to try to bring up that graphic for everybody here so we can kind of see that. Here you go. This is, I'm hoping it's the right one. So June 12th. Yep, that would be right. That's where we currently are. And you can see that by year end, actually the year end shown definitely people expecting there to be rate cuts. Well, this isn't the one I was thinking of as far as the dot plot goes. This is it, but it seems a little bit off here. It's interesting going out to 2026. It looks like they're talking about 3.1% would be the Fed funds rate.
Is that the number? I didn't go out that far, really?
Yeah.
Okay.
And they say longer run, it looks to be about 2.5%. But again, my question, or not question, but my thought is, why? If you're firing on all cylinders, if the economy's looking good, you don't want to put too much fuel on that fire by cutting rates again. And really the only reason I think that you'd want to be cutting rates is if we saw unemployment surge dramatically. Yeah, it's at 4%. That's well below historical norms, so that's a non-issue.
Right.
And unless you're trying to juice the economy and get a huge spike going into the election, I don't see the need to do it. It's interesting because we saw other central banks recently actually cut their rates, lowering their rates going forward. So maybe we're the keep up with the Joneses market.
And I'm just curious, Merlin, as part of the dialogue, when you say that the Fed might be looking to juice the economy, do you mean juice the economy or juice the market? Because I'm convinced the stock market, the stock market is not always a proxy for the economy, as we know and see.
True. Let's just say juice the. I would say juice the market, juice the stock market, because that's what I would. It's right. The data. I think if I was the current president, I could look at the data and say, hey, see guys, we're doing okay. Right, we've done. I had to inherit. Of course, please don't get political. I'm going to make a statement like a politician would, and I'm going to say I inherited a garbage, crap economy from my previous predecessor. It was terrible, and I had to work extremely hard with my team and my administration. And look what we have done. We brought inflation down. We've all these metrics, and we'll quote all of the broad economic data. But more realistically, what are you going to vote with? You're going to vote with your 401k. You're going to vote with your investment account. You're like, holy shnikes, I'm up 25% this year. Yeah, go XYZ president. Who cares as long as my rate of return is putting more money in my account? So I think, yes, it's to juice the stock market, get it to pop even more going into the end of the year. So could be an even bigger year. Big Eb says small caps need to be juiced. They might with some more capital infusion and lower rates.
I'm going to play the naive person I am. I didn't realize it was ever the Fed's mandate to juice the stock market. And I'm looking through the Fed mandates. I'm missing that one. When was the Fed's job to juice the stock market? I missed that one.
I thought it was funny. I can't remember if it was this last meeting. I think it actually was this last meeting or the one before. Jerome Powell was talking about, as you know, we have a dual mandate of full employment and keep stable pricing. And then he's talked about how they were going to hold rates longer and he was quoting all sorts of other things that have nothing to do with the Fed's mandate. And I was thinking, okay, you kind of just overstepped your boundaries there, but we'll let it slide as long as the markets perform well.
Well, it's nice to have mandates that are mutually exclusive so you can pick which one you want to focus on.
Yeah. Yeah, it's funny how this whole political machine or this machine is used from a political perspective. I always make fun of Elizabeth Warren just because she's writing letters to the Federal Reserve demanding that they cut rates because it's killing jobs and there's really high unemployment. It's like, I don't know what world you're in, but 4% is exceptionally low. You're doing great with regards to that.
And it's such a foregone conclusion. It's just even inane for her to be mentioning that. Yes, raising rates is going to put more people in unemployment, and that is the reason it's being done. Let's not be soft-selling it. That's the whole reason it's being done.
Right. Yep, absolutely. Chio says, Merlin, could you ask Bill, what is his opinion on Bitcoin and cryptocurrencies? I know you've said this before. I'm curious. I think you're a student of the markets, and you kind of look and see what's happening. What's your take? Has it changed?
It has, and it's gotten a little more pessimistic. And kind of following up on the conversation we had is, I think that at this point they have to change the name. It should be Bit Asset, maybe.
Yeah.
But I don't know anybody that's actually using this as a currency. And when we started this conversation years ago, that was what we fully envisioned, a seamless, borderless currency. Here we are years later, and the way I see it is the only way you make money on this is through the greater fool theory.
Yep.
You can't do a fundamental analysis. So those people who are long it, talk it up. Those people who are short it, talk it down. I'm discouraged that it has not actually evolved into the cryptocurrency I wanted to see. Now, that might happen. We'll get platforms that will let us process trades and clear trades, but it's not going to be quick. So I think calling it Bitcoin at this point is a misnomer. It's not the currency I envisioned and hoped and wanted. Now, do I own it? Yeah, I'll be honest with you. I own it, but I don't trade it. I don't trade something I can't value. How do you know if Bitcoin is overvalued or undervalued, in my opinion? So I love the technology. Distributed ledger technology is great. It's here to stay. Banks are using it, DTC, the markets, the exchanges. I mean, distributed ledger technology, the technology that works it, is a game changer, literally. We couldn't process the amount of trades we do without it.
Right.
But as a asset, Bitcoin, I'm not seeing the evolution I wanted to see. If I may ask, What's your opinion? You teach classes on it. You follow it much more than I.
I actually agree with a lot of what you said there, certainly about the greater fool theory. Those that like it, talk it up. Those that are short it, talk it down. I think that when you're looking at a currency, a monetary system, basically what you're looking at is an alternative cash system, right? It's digital money. I think that any government, any controlling power is going to be extremely resistant to that, because the more people that use Bitcoin as a currency, and if it were to become quote unquote legal tender in the United States, then our Federal Reserve, our Treasury, our government loses a massive amount of control and power. And I think that will be the piece that kind of prevents it from being mainstream in the United States. However, we do have other countries around the world that are using it as a payment network. Talking about El Salvador. Now, I know El Salvador is miniature. I mean, I think it has the economy of like Los Angeles, but it's a start, right? And if we see more countries like maybe Argentina, Miele has been very clear he'd like to use Bitcoin as a currency, then maybe it starts to gain some adoption. And I think it may get to the point, not in 1 year or 2 years, but maybe 5 or 10, where we have so many different smaller countries using this as a payment system that we look at it as a government and go, okay, we have to adopt that because we want to do quick, easy business with these people, and it'll slowly come in. You can't make this change overnight.
Right.
So that's on Bitcoin. The other side of it is, if we're looking at payment networks, there's the ISO 20020, which is an electronic standard for payment networks around the world trying to replace SWIFT. We already have Cardano, I think Avalanche, you have Stellar Lumens, you have several crypto projects that are ISO compliant and now can be those payment networks. So Bitcoin by itself, I think, will have some struggles just because they're not going to let a cash system in. However, you have different payment networks that might surge. And I think out of the 2 million plus projects, there are some incredible opportunities which will make huge strides going forward. But, it's different. All depends on the project.
And I'm curious, and I should follow up more. El Salvador adopted Bitcoin 2 years ago, and they thought they were even going to be coming out with Bitcoin bonds, which they had to shelve. Those issues never came to market. How is Bitcoin as a currency working in El Salvador? I have not followed up.
From what I've seen, it looks like it's going okay, but I'm not going to, make a definitive statement until I actually set foot in El Salvador. It actually was on my list of places to go and check out. Can you use Bitcoin quickly and effectively? No, it's a 10-minute block time. Right. But, you have these layer 2 networks which can now do instant transactions and batch transactions, which make it a payment network. So I'd like to go down there with a couple $1,000s in Bitcoin and just see what happens and see how it works. I'll let you know if it ever happens.
All right. If you disappear for a couple of weeks, we'll know where you are. You're undercover in El Salvador.
Undercover in El Salvador. No, I'll let everybody know. I'll probably be broadcasting live from there. Like, here, I'm making a transaction with Bitcoin. I see a lot of celebrities in the space doing that. It's pretty funny.
I'm buying a beer with Bitcoin. If we can get to the system, the point where we can actually process trades and clear trades and use it as a currency, I'm all in favor. I think the technology is there, but I'm not seeing that yet.
A question that came through a couple times here, and I don't want to take too much of your time. I know we're getting late here. Saudi Arabia talking about not using the dollar, and I know that they're saying they're not going to use the petrodollar, and I heard some say that was just a myth. It was debunked. Others saying it's true. What's your take on that?
No, there are transactions now being done by OPEC in non-dollar transactions, and the biggest one is rupee. They've done two transactions for 200 million rupee using local currency out of India. And what I've been expressing to the OTA community is this is my biggest fear. The reason we have so many countries that are willing to buy our bonds, why we have such a good bid to cover ratio there, was because they have so many dollars to invest. Mm-hmm. And they have so many dollars to invest because they sell oil or gold. No matter where you sell oil and gold in the world, it's paid for in dollars. So, OPEC was a dollar-based system created, 65 years ago? If we were doing a new system today, it wouldn't be dollar-based. Right. We were OPEC's largest consumer at the time it was created. We're now a competitor. It doesn't make sense for OPEC to be dollar-based. And once they start moving away from the dollar, that's where I start to worry, because then we're going to lose our bond buyers. Yep. Saudi and Kuwait, up until the pandemic, were the number 2 and 3 buyers of our treasuries because of their oil sales. We need them. They're not making a political statement. They just have dollars to invest. Right. Now that OPEC is trading in yuan and in rupee, that really concerns me.
And to what extent? So if it does continue down that path, where we're going to use less and less dollars, we're not holding dollars anymore because we don't need to, or at least not as many as we need to.
Right.
Ultimately, what happens, I think, the government's standing there going, hey, we need some buyers for our bonds. Who's it going to be? And there's no takers. Okay, we're going to jump that to, how about 6%? Any takers? 7%? Any takers? Is that what's going to happen?
Oh, yeah, no, to explain, and thank you for making me clarify. I'm not saying the government won't be able to borrow the money it needs to, because we've got this system we've talked about of primary dealers, those hostages who have to be at the auctions. So even if every other country in the world boycotts our treasuries, and I'm not calling for that, we'll still sell our treasuries because we have these hostages who have to be at the auction. The question, though, becomes what interest rate are you going to be able to sell them? Mm-hmm. That's the real issue. Right. We know we'll sell all we need. We have these 24 firms that are hostages. But if everybody else is backing away, it means the government's going to have to pay higher and higher rates of interest to borrow that money.
Yeah. Interesting.
Yep.
Interesting. Well,
yeah, no, that's my nightmare scenario. When I saw rupee transactions this year, that was my real. That was a turning point for me, thinking, okay, the system is fundamentally changing, and it does not bode well for the U.S. if we continue to try and borrow as much money as we are.
How do you position yourself for that? If you look down the horizon, and it sounds to me like your forecast is this is not going to get better. It will continue to progress in, hey, we'll just use whatever currency we want. How do you position yourself from a financial perspective to capitalize on that or hedge yourself?
I think you look at non-dollar assets.
Oh.
Yeah, even ADRs on the stock side, just any way to diversify your portfolio away from the dollar.
So you do like crypto. I got you.
You got me. Well done. Yeah, no, I think you, again, I don't want to be too pessimistic, but when I look down the road, I get worried that fundamental important issues like the deficit, even like Social Security, there are fundamental issues that our elected officials just refuse to touch that third rail.
Yeah.
And without some political courage, these situations are not going to get better.
All right. I like it. Well, I have your schedule up here. We'll walk me through what we've got here. There are, where is it? You have my face off the screen. On this Friday at 2 p.m., you have your weekly companion for the focus class, which is Bonds, Canary in the Coal Mine. And then the actual full class will be on June 27th. For those of you who like to know more about bonds and the interworkings, the relationships between those bonds and the opportunities, that will be June 27th. The focus class, is that a full one-day class?
Yes. That's a 10 to 5 one-dayer. And exactly as you said, we get into bonds themselves, but we also try and highlight the interrelationship between the different asset categories. As we were talking, hard to trade equities these days without knowing what's going on in interest rate environment. There's such correlation between the two, or currency or other assets. So we focus on that, but we also highlight, how the bond market works, because people don't understand bonds, right, and they really could and should.
Well, it's funny. It's one of those things that your financial advisors certainly try to convince you to buy into and hold bonds over time, and it may as well know what they are and what the impacts for you are going to be. I did a show yesterday asking, do you have enough money to retire, and utilizing bonds as an income stream, locking in and committing to a certain amount of rate of return for 3 years, 5 years, 10, 20, a great tool for you. Guys, I put a link to those books that Bill has as well. He's got a great special on here. I can bring up his page. If you go to aftraining.co, you can go to his little shop tab there, and he's got these books. You don't want to buy one. Just don't buy one. It's not cost effective. You buy one book, it's $15. You buy all three, it's $25. So I'm the sales guy for you today.
You're shilling great for me, Merlin. I appreciate it. But no, and Stuart Veal, the author of these, really did a good job. I edited his work, but Stu is the leading author of the best textbook in America right now, and he did a really good job. So I offer these to my institutional clients on the programs I'm doing this summer. So we've been trying to get the word out to your folks as well. So thank you for that.
Yeah, my pleasure. And I got one more question for you, and this is kind of a weird one. You are. You're a unicorn when it comes to the bond markets, and I appreciate you taking time to come on the program and help me understand more, and my viewers as well. And I'm going to hold off here on this question because there's a commercial break happening in about 12 seconds. It shows up on my screen, tells me when the break is. So I'm going to wait and how do we say, dance around it until the commercial break happens. Ready, guys? 3, 2, 1. Here's your commercial. Let me know what you got. it's funny. Sometimes it's a Domino's pizza ad. Sometimes there's all kinds of weird commercials that come through.
Okay.
All right. My question is this. You are in a unique position because as an educator, you are helping people understand something. You shape, and in this case, you're shaping people's financial future by explaining to them how the bond markets work, the inner workings and all that. Do you ever go through these courses? And I'm sure you probably prefer the younger people over going into an institution, a bunch of older people. I certainly did. Do you ever just go into one of these classes and finish and go, holy cow, that was like the brightest person I've ever met? Like, how often do you come out just awed at how intelligent some of these guys are? Or the opposite side as well?
That's a great question. And the reason I'm smiling, as you can see, is I actually had that experience just this last week. I was down in Miami with a hedge fund client, and they are just starting to do a summer intern program. They brought in 10 summer interns, and they groomed from some very good universities. And I got to tell you, this was an exciting group. Most of them were computer science majors, so they didn't know the financial world. They knew programming and computer sciences, so it was a smart group of people. But I was only able to get through about 2/3 of the material I wanted to, or needed to, just because they were such a young, energetic group. These were summer interns. And I went to the employer, who's a major hedge fund, and I said, whoever's doing your hiring, they're doing a great job, and you want to keep these kids. And that's what they use these programs for, is they've already got their eyes set on people they want. They're identifying them in their sophomore and junior years in college now. Right. That's what's going on here. I had a summer intern group this summer, just last week, from Millennium, that was just a lot of fun. They even came in early. We had the Fed meeting on Thursday, so we did the CPI number. These students came in early so we could watch CPI together at 8:30. You don't get a seasoned group of executives that are necessarily showing that much energy.
Right.
So the enthusiasm of the young is almost contagious. I had a great time with them.
Nice. Yeah, I was very lucky when I taught over in Italy, and actually similar to what you're talking about, I designed the first live trading lab at a European university. And
really?
It got so much press, so much publicity, that I had members from the local banks would come and they would say, hey, can we be in your class? And I said, no, this is for students. And they said, we just want to see what you're doing and see the students. And at one point I had like 6 executives standing in the back wall the entire session, and they were talking to all the students, and it was like a recruiting thing. Like for them, like there's nothing like this exists. It was very rewarding. It was one of the best things I've ever done.
Yeah, when you can capture that group's imagination or interest, they're exciting. They really are.
It's the future. So, you gotta be forward thinking. And I went in to teach for one of these banks. It was really funny. They brought me into the trading floor, and I was talking about direct access technology, which these guys knew nothing about. And I walk in there, and I got a nice suit on, but I had a long hair and it was pulled back in a ponytail. And I noticed these old Italians were not giving me the time of day. And I asked the guy, I said, sir, is there a problem here? Because you're not even making eye contact. You're like, you'd rather I just don't be here. And he goes, right. I've been trading these markets for 30 years. I'll learn nothing from you. You're a child. Right. And I was like, I appreciate that. And I'm glad that you had the chutzpah to say that out loud to me. But let me tell you, I am the future. And I will run circles around you with new technology. What you're using, sir, is like a horse and buggy, and I'm driving a Ferrari. So learn how to drive that Ferrari. And he was like, I'm sorry. Okay. But the young people are like gobbling it up, and the old ones are kind of like, I've been there, done that. I know it. It was fun.
And that's the resistance I find when you get a group of senior people to educate. And I had one a couple of weeks ago. And when they've got, a decade or two in the business, they kind of look at you with closed arms, like looking at you like, go ahead. I dare you, teach me something. Yeah. Mm-hmm. And you got to, you do, it takes a little while for that resistance, but the young kids don't have that resistance. So they're really sponges.
Yeah, no, it's enjoyable. All right. Well, hey, continue to do that good work, shape the future, get that bond market back on track, get our yield curve normal. I'm voting for you for, the FOMC chair. I would love to see you at the podium at the press conference. I think it'd be just so much fun watching the Bond King deal with, Joe Kernan and Maria Bartiromo at these press conferences.
Steve Leeson,
yeah. There's a few good ones. All right, man. Well, hey, thank you very much. I'm glad you made it. I appreciate you coming on and taking the time. Thank you so much. And
always a pleasure.
And have a great class.
You too. Enjoy your XLTs. You've got some crypto classes coming up
tomorrow morning.
Series, yeah. So good luck with your class as well.
Thank you. All right, Bill. Thanks so much. Have a fantastic remainder of your day, my friend.
Be well, folks. Be well. Thanks, Merlin. Yep. Cheers.
Guys, that was Bill Addiss. You can find out more information at aftraining.co. I will bring that page up here for you. I also put the link into chat if you want to buy those books from Bill. That goes through his shop here at AF Training. He's also got some videos there. Just always trying to teach, educate, and learn. So I'm a big fan of Bill and what he does, and certainly the patience he has to deal with me and my lack of understanding of different market pieces. And he's educating me every time he comes on, and I hope you guys enjoy that as well. All right, this is not going to be an hour show. Let me real quickly go to the exciting stuff. I'm surprised no one has mentioned it in chat yet. Where is it? I had it listed over here. We have a new leader for the most expensive company in the world, the biggest company in the world. We talked about this, was it last week, I think, or week, maybe it was this week. I'm losing track of time. We talked about someone saying that NVIDIA, by next year will be the biggest company in the world. And I said it could happen by the end of this year. Most likely, could happen the end of this month. It happened today. Microsoft was leapfrogged by NVIDIA. NVIDIA is officially the largest company in the United States. Incredible what it is doing. Bravo to them. Hopefully the reason that we're seeing this is they're going to change the future of computation, which will impact businesses on a huge level. And that may usher in this whole new era of AI, artificial intelligence, augmented reality. But we needed to see an upgrade to our chipsets, our computers, and this may be the piece that does it. So bravo to NVIDIA, really incredible. Yeah, NVIDIA, I think it was 3.5% today, but here's the chart of NVIDIA and VEDA. 3.51% today. It's up another little bit in the after-hour session, but I mean, this is probably one of the most incredible charts. And I feel bad. I'm sure Big Eb is probably cursing my name because there were a couple times where we're like, this could roll over here, so protect yourself. And I know you bought some puts, but I would not even worry about that because in the long run, you're making much more on your underlier, and hopefully those puts, you never need to use them. It's like homeowners insurance. You don't want to use it, but you have it anyway just in case. And if this did roll over and crash, you'd have been protected. At this point, it's defying the laws of physics in my mind. It's just an extremely strong trend to the upside. You have all these unfilled gaps going on. And yeah, it is the biggest company in the world. It's now NVIDIA, I think 3.3 trillion, Microsoft at 3.2, and I think Apple is at 3.1. Incredible. All right, let's see. What else do I have for you tomorrow? I'm real quick going to finish this one up because I don't want to do an hour show, and I am exhausted. I was recording videos from 11 p.m. till 5 a.m. This morning, and now I'm going to go take a nap here. But for the U.S., you don't have too much. We've got a bank holiday. I will not be doing a show tomorrow because I'm teaching in an 8-hour crypto class tomorrow. It starts in the wee hours of the morning, goes till 1:30, so I'm going to be gassed. So no show for us tomorrow, but I will be back on Thursday with Don Dawson. We're talking commodities. It's been a long time since I've had Don on the program. I'm excited. He's one of my favorite traders of all time. Down to earth, straightforward, no fluff, just this is how you do it. This is what I'm looking at, and this is how you trade. So I saw one question come through for me for Don Dawson. If you have any questions, email me at TraderMerlin@gmail.com or go down below and put on any YouTube video. You can post your comments there, and I will incorporate those in. Will sent in several questions, which I'll try to get to on Friday's show. So Will asked me like 5 or 6 questions on a YouTube chat. I might make a Will day here because there were so many questions out there. But again, hope you enjoyed today's session with Bill Addiss. As always, he is giving you information that I think is a little bit harder to find in perspective from a 40-plus year market veteran on bonds. I find that very beneficial. Thank you guys so much. Have a fantastic remainder of your day. If you have June 19th off tomorrow, good for you. Enjoy that. Do something special. I will see you guys on Thursday. Take care. Unless you're in the crypto program for OTA, I'll see you tomorrow morning. Take care.